right, Dick, why don't I get us started and then I'll have you chime in. You want to come in on like slide 2?
Yeah, that'd be good.
Okay. Okay, well, welcome everyone. My name is Dana Bickford. I think most of you have either met me or seen me. And I have Dick Hendy on the line. We're prone to working together with Acquira's clients. And we've got, we're going to go about this in a little bit different manner today. Rather than a lecture, which if you're listening to me can be pretty boring. What we're hoping to do is encourage some engagement from each of you. And so we've got three modules to talk about. I don't know that we'll get through all of them. It depends on the discussion. And if we don't get through all of them, we'll come back to you with whatever we miss. The first one is really sort of addresses the issue of what's the ideal transaction for me? What's the ideal company? What's the ideal deal that I should be looking for? We'll talk about that for a few minutes. Module 2 is the notion that, you know, how do I evaluate whether this is even in my ballpark? Give me a back of the envelope type approach to figuring this out. So I'm not wasting a lot of time on things that are too small or too big for me. So we'll go through that. That will probably be, I think, you may prove me wrong, but I think that may be the shortest module that we have today. And then the third one is kind of my favorite, and it's one that should be near and dear to everyone's heart. And that is, how much cash do I need to do this? And what does that look like? What should I do? And what should I try and avoid doing? And so, again, what we're trying to do is encourage participation from the group, because each of you comes to this with a different set of experiences and a different set of concerns. And so what we'll do is when we get to the basic questions, I'll leave the question on the screen and solicit input from the group. And, you know, feel free, don't need to raise your hand or anything, just be polite to each other. And as people come up with answers to the questions, things that make sense to them and that resonate, let's talk about them and see what kind of participation we can get. Does that make sense to everybody? Mm-hmm. Okay. So module number 1, what's the ideal deal that I should be looking for? Should I narrow the focus, or should I look at anything and everything that Dana, Dick, and Acquira can throw at you? So Dick, take it away.
Okay. Yeah, and I think the approach to this is, I know we all want to be business owners, or you all want to be business owners, and maybe have worked for a large corporation for a number of years and gained some experience in a particular industry or field. But when you say I want to be a business owner, you know, what does that mean? Do you want to own a landscaping company, or do you want to own a machine shop? You know, there's a lot of different skill sets that fit into those, a lot of different types of financing is needed on both of those. So we're going to try to help you come up with at least some ideas or thoughts, and you may already have, whether you should narrow that focus or do something much bigger. So next slide, Dana.
Okay.
What we're going to ask you for participation from everybody is, what are some of the big picture things that you would put on your list for the ideal deals that you would want somebody to be looking at? So what are, you know, just some of the things maybe that you put on your list when you're trying to narrow that focus?
Geography, size of business, cash flow, industry, number of employees, age of business.
Okay. And who was that was throwing all those great ideas out?
Quinn.
Oh, good. And anybody else got any thoughts or ideas?
Yeah, I think a retail business versus a B2B or commercially focused.
Why is that, Brian?
Because if you're B2B or commercially focused, it's going to tend to lean heavily on sales skills, whereas retail is going to be more marketing skills.
Mm-hmm. Are there any other reasons that might cause you to think a little differently about the two different types of businesses? Might be an HVAC company that focuses on residential versus another HVAC company that focuses on commercial. Are there other?
Oh yeah. In that case, it's sort of like the commercial is going to be more project based and have a feel like where maybe construction like experience or skills are going to play into it more than retail come to service is just a more of a service background or service skill set.
Right. But I'm thinking of something specific that is, there's very different aspects to commercial versus residential business.
I think about working capital management and when you get paid.
There you go. Go a little further into that, Ben.
I mean, in most residential services, you get paid immediately, whereas in commercial, they can kick your payment terms out 30, 60, 90 days. And especially with new construction, a lot of times you get paid 75% up front and then 25% when the project finishes, which could be 6 months from the date that you get your 75%. So there's a huge cash flow that you have to have. Additionally, new construction is typically lower margins than service. And you're going to have lower margins on the commercial side than you would in a residential side.
Yeah, excellent points. The key there to me, as I think about it, is what it does to your cash flow. You could be able to tell somebody I have an HVAC business, but it's really two different businesses when you start looking at cash flows. What you have to do to manage that cash flow in a commercial business versus in a residential business is significantly different. The risk profile significantly different, and you could end up doing a lot of work for somebody and not get paid for a very extended period of time, and ultimately not get paid, just depending on the nature of the relationship. So, especially as you're just going into a business that you haven't been running for a while. So, thank you for that. That's an excellent point. Are there any others?
I would add barriers to entry, right? Are there going to be certain licensing requirements for the business or not? Can anyone start that type of business, that type of thing?
Yeah, great point. Thanks, John. Great points. What others? Anything else?
I like to think about recession resilience. Are people going to continue to buy this? Do they need the product or service, or is it something that's discretionary?
Yeah. Good going. Anything else? Anybody else have any ideas? One of the issues may be, depending on the business, is the amount of capital it takes to be able to service your customers. You know, some of the highly complex businesses can be pretty expensive, and you have to be ready. You have to know it and be ready to fund the kind of equipment that you need. And it also, if you're running a more complex business, more complex HVAC business, your talent may be more expensive. So, and there's also, you also may be competing with unions for your talent in that kind of a business. So keep your eyes open when you're looking at those businesses.
Okay, that next slide.
Okay, I think we hit most of these.
Yeah, I was really impressed. You guys have done some homework here, thinking about some of this stuff. One of the things that I got on the list here is the industry growing or shrinking. And sometimes if you want to obviously look in a growing business, you don't want to look in a shrinking business, but that's not to say that there's some opportunities in a shrinking business too, where you might get a deal on it and come up with a new way to sell or to market or a new product to add to that list and do a complete turnaround. But those are, I'd rather buy a growth business than a shrinking business. And then, the type of business in the industry, you could say the energy business. Well, there's a lot of segments in that energy business. There's upstream, downstream, drilling, supply line chains. So, be thinking about if you are married to a particular industry, do you want to narrow that focus down into specific businesses within that industry? I think somebody mentioned size of the business, annual revenues. Somebody mentioned employees. We looked at both inside and in the field. If you depended upon the cash register to ring of people out in the field doing things, then you probably should have more people in the field than you got inside. But and also you may not want to manage 100 people. You may want to start out managing 50 or 75, whatever the number is. So at least put that down and find that out up early on. Number of locations and distance and jurisdictions. I think Dana mentioned that a little bit. You might be over a state line, and one state, the particular field is more union and it is non-union. So that could have a real serious play on the number of people that you have and distances you got to drive, licenses you may have to have in one state and you don't have to have any other. So that's something to keep in mind. And then physical locations. If you live in Billings, Montana, and the business that you're going to buy is in South Florida, that's a pretty good climate change for you and also cultural change. So you may want to, not look at particular businesses in states or cities where you think you're going to have a major problem moving or the cost of living is more expensive, like in New York City. You may not want to, grab one of those deals. And then Dana mentioned the capital requirements. If you need a lot of fixed assets, that's going to increase the amount of money that you're going to have to borrow or figure out how to get those fixed assets on the books. And then the price, if you've got $1 million and you're looking at a $20 million business, you're probably going to have a little problem buying that big a business with the amount of equity that you had. So anyway, I think we really covered this list, and I appreciate everybody's fine suggestions and input. Anybody have any questions before we move on? Okay, now, Dana, next slide. Whoops. Dana, did you drop off?
Looks like we lost him.
I can help present, Dick, if you need one.
Yeah, the next slide was narrowing or focused. Can you bring that slide up?
Sure. I'll just pull it.
What we're going to ask for you think about here is, and probably some of you have thought about a little bit, and that is narrowing your focus and what that will accomplish. So if you're looking for anything and everything, it's number 5, I think. Yep. So who has some ideas on narrowing your focus? What are some of the benefits of narrowing your focus instead of trying to look at anything and everything?
You don't have all the time in the world, so you can't look at everything. So you might as well look at the things that you're actually interested in.
Okay. Anybody else?
It'd be good to rule out things that you're pretty convinced your skill set is not going to line up with.
Okay. How
You
about
could
anybody
potentially
else?
develop more of a expertise if you're just focusing on a few industries versus 20 different industries. You have more of a expertise in terms of how those businesses run and where you can add value.
Yeah, and the more that you look in that one particular area, then you start coming up when they give you a package. When a broker gives you a package, you start thinking about questions way before you even dive into it.
Mm-hmm.
Anybody else? Okay, Andy, if you go to the next slide, we wrote down some benefits of a narrowing the focus. Number one, I think somebody alluded to it, you save time, you can't look at anything and everything. And it weeds out the deals early on that probably are just not doable. Again, going back to the example I used, if somebody wants $20 million for a business and you've only got $1 million in equity in it, you might just well rule that one out because you don't have enough capital to do it. And I also think it limits the frustration. I mean, you can look at deals and you look at deals and look at deals and you don't see anything that's, either appealing to you or that works. At some point in time, you're going to get frustrated and you're going to say, well, maybe this isn't something I should be doing. Or you may decide to, beg off for a while until you get some other expertise or another way to look at it. And again, there may be some opportunities that you missed. And then if you get an attorney involved, if you get a CPA involved, if you get anybody involved that you got to pay money to, the more deals that you look at and the more money that you funnel into these deals and they don't work out, then that takes away the capital that you have to do the investment in the deal. And then it also, I think, once you get out there and known as a serious buyer in a particular industry, then I think your broker is going to be more, interested in giving you deals that probably are going to work than something that's not going to work. So you become a serious buyer, and they won't waste your time with looking at deals that either don't fit in your boat or not going to make it. Okay, the next slide. Now the reverse of that. What are some benefits of looking at anything and everything?
Well, if you're,
Sorry.
go ahead. I was going to say, if you're trying to get something done more quickly, it is going to increase the top of the funnel for you.
Okay. So speed. Okay. Anybody else?
I captured you just might have more exposure to areas you hadn't considered. And I know for me, that's how it worked. As I expanded, I started considering businesses that weren't narrowed into the overly crowded HVAC plumbing sector.
Okay. Have you had some experience in that?
Oh, well, broadening out, I'm saying, yeah, that's what I've tried to do. Now I'm opening up to look at more millworks businesses, more businesses, even landscaping that I wasn't considering before.
Okay, good. Anybody else?
Yeah, I think you could, in that vein, you might find something a lot more profitable than you thought, or the area that you were narrowly focused on.
Okay. Any other thoughts or ideas? Okay, let's go to that next slide and we'll kind of talk through some of the ones that Dana and I came up with. You get to see more opportunities. I think somebody mentioned that. Something that you may have overlooked if you do want anything and everything, I should say. And then you start gaining some experience on making a deal. Once you've looked at a couple of these and buyer or the sellers got back to you and said, well, we'll do this, and you pick up a few things, so you're gaining more experience. And again, you become a more sophisticated potential buyer because you've got some knowledge that you didn't have when you started this process. And this one, I think somebody alluded it to, you may see that diamond in the rough. There may be just a deal out there that, the seller is in his 70s and he really wants to get out of it. You like him, he likes you. You work up a deal that you may not have even thought about or even had the opportunity if you don't take a look at that anything and everything. I think the first comment that y'all made was speed, and that again is a factor here. If you're looking at anything and everything, it's probably going to speed up the time that's required for you to find that diamond in the rough or that deal that you really want to do. And then you may find an opportunity you never thought of. And I think somebody alluded to that too. I think it was Michael, he may have been looking at a machine shop and found a landscaping company that really could be something that he could really get into and involved in. So the next slide. So that was the end of module 1. And does anybody have any questions or comments? What the idea here was to, if you haven't, to take a piece of paper out and write down some of those things that we talked about. What are you looking for from a geographic standpoint, cash flow, industry, number of employees, and that type of thing. And then kind of decide what you want to do, whether you want to be look at anything and everything, or you want to focus on specific deals. And I think that will help you in that process and finding the right one. Was that exercise helpful to you? Have you all done that, or if you haven't thought about that, would give you some ideas to think about?
Mm-hmm.
Okay. Ben put a comment up. Thank you, Ben. And Brian too. Thank you. So now we're going to go to number 2. Next slide, Andy. Number 2 is something that Dane and I came up with. So you found this industry that you like, you found this deal that you like, you and the seller hit it off. And the next piece of the deal is trying to figure out, can you buy it? Can you afford it? And instead of, asking for a whole bunch of information, going through and analyzing it, and then 3 or 4 weeks later find out just doesn't fit, or you get all the information and take it to the bank and it doesn't fit for you. We thought it would be helpful to just talk through some back of the envelope calculations so that you can either weed out that deal that makes sense or doesn't make sense, and save yourself some time. So next slide. So what are some of the things that you think we should consider in this calculation back of the envelope, whether you can afford to make an offer on this deal or not?
So the equity you can bring and
Okay.
the financing you can expect to get qualified for,
Okay.
and then your purchase price.
Okay.
Yeah, I think what's super important is the asking price as a multiple of cash flows, because anything over 3.5 is tough to finance.
Right. Okay. Anybody else? Okay, Andy, go to the next slide. And here I'm going to walk you through a particular situation. And I just threw these numbers out here so that, the 15% in cash, and it may be 10%. The owner may not want to take back anything, or, debt service coverage. You heard the other day in our meeting with a banker that 125, he likes 135. So no, I think the SBA was 115. He likes 125 or higher. So let's say you had a asking price of $2 million, and your closing cost with attorneys and points to the SBA and everything winds up to be $100,000. And then you need operating funds for that period of time until you start generating revenue coming in, and you calculated that's $250,000. So the amount of money that you need then to close this deal would be $2,350,000. So everybody follow that addition? Okay. So now let's say that the bank has come up when they say, well, with this particular industry, you need 15% down in cash, and we'd like to have the owner take back some paper too, so he's got 5%. So the 15% of the deal means you would have to come up with $352,500, and the piece that the owner is going to take back is $117,500. So that leaves you $1,800,000, $880 to finance. So I looked at SBA usually charges prime plus and they can go up to prime plus 275. So right now prime is 7.5. So 275 over that gives you a 10.25% interest rate. And let's say they do that for 10 years. So $1,880,000 at 10.25% for 10 years would give you a monthly payment of $25,631.12. So these debt service ratios are based upon an annual payment. So you multiply that 25,631 by 25, and you come up, or by 12 rather, and you come up with $307,000 and $572 for your annual payment. $307,572. So now let's calculate the debt service ratio. So did everybody understand the second piece of this here, how I got those calculations? Okay.
Mhm.
So now we're going to figure out if you can cover the debt service. So let's say this business has $2 million in revenue, and that the cost of goods sold in the business is 50%. So that's $1.3 million. And then you have a 35%, or I'm sorry, I wrote that down wrong. It's 65% cost of goods sold. So you've got a 35% gross profit margin. And your expenses, overhead, rent, and that type of thing is 30%. So you've got $100,000 left to go to debt service. Well, as I mentioned, your debt service is $307,000, so that $100,000 you're never going to get there. So what would you need to get there to make that deal work? Well, you take that same $2 million in sales, and let's say that you were able to reduce the cost of goods sold to 50%. That would give you a 50% gross profit margin, or $1 million. If your expenses stay the same at 30, that's 600,000. That gives you $400,000 worth of available cash to make your debt service payments. And that more than covers 125. It's a little bit short of the 135, but you can see that you need to know what the company's doing from a gross profit standpoint and expenses to sales to kind of get that back of the envelope calculation, whether this would debt service coverage. So I went through that kind of quick. Does anybody have any questions or comments on that? Dana, I see you've joined us again. So do you have anything to add to that?
I think to hear if people understand it. If anybody doesn't understand it, it might be a good thing to just, could we put that down on an example, have Andy send it out to the group?
I can, yep.
I think that'd be helpful, because you can understand it while you're listening to it, but then you may not be able to recreate it when you're actually looking at a deal.
Yep.
Yeah, that'd be a good shortcut, because you can get to this through the SBA model calculator, but it takes some time to plug it all in. So there's this back of the envelope is helpful. So for assumptions around closing costs, I think the calculator already has the SBA fee in there, but all the other stuff, do you think about it as a percentage of the price, or does it tend to be, as long as you're in, $2 to $5 million, it tends to be $100 and some thousand dollars? How should you think about the closing costs?
On closing costs? Well, the SBA is going to charge you 2.75% if the lender's the lender that sells their paper. So whatever the loan amount's going to be, you're going to pay that as a guarantee fee.
Mm-hmm.
If it's got an appraisal, and most SBA lenders will want an appraisal of the business, those costs run anywhere from $2,500 to $3,500. One of your biggest expenses is the lawyer.
Mm.
And I would, and it kind of is, why should I pay for two lawyers? But the SBA is going to have an attorney, but my recommendation to you is to get an attorney that represents you, not the bank and not the seller.
Amen.
Because he's going to have he or she will have your best interest at heart. So, you may be paying 3 lawyers in there, but I can guarantee you at the end of the day, that's going to be well worth whatever the cost is, unless you get a Wall Street attorney that's charging you, $850 an hour. I certainly wouldn't recommend anything like that. But to answer your question, Brian, I don't know of any percentage of the dollar amount closing cost. I've been through so many of these that it really depends upon what the market will bear. Now, you could get somebody that would do an evaluation of your business, and they may be way overbooked. And if you're in a hurry to get it done, so yeah, I can do it, but it's not going to be my 3,500. It's going to be 6,500 or whatever. And so there's so many variables in there like that. I've never seen anything that come up with a percentage wise, but just and when we get into module 3, there's some cash flows or cash flow things that we come up with some cost that some of them are closing costs, but others are more operational type cost. And those are the ones that I've seen that have been usually not enough money's been calculated in there. And then you get a rude awakening after you bought it and after you're sitting in the chair for 30 days.
So you're going to talk about the working capital or operating funds. Okay, I'll hold off for that then.
Hey, Dick, can I throw in a couple thoughts here about Ben asked a really good question, or he brought up a really good point a few minutes ago about multiples. And virtually everybody I hear talking about doing this kind of transaction talks about multiples. And frankly, multiples they're kind of guidelines, but they don't determine. In the general sense, they have an influence on value, and you can use it to your advantage. But multiples are not necessarily the only indicator of value, and there are a lot of things that impact value that a multiple doesn't account for. And so clearly, the higher the multiple you pay, the thinner your debt service coverage ratio is, and all those sorts of things. But as you look at the debt service coverage ratio that the SBA requires, and I don't think we've got any SBA lenders on the line, and they would probably be upset with me for saying this. As I look at their debt service coverage ratio, other than the way you just explained it, Dick, it's almost irrelevant with companies of this size. Now, you have to have coverage higher than your debt service is. You just have to do that, or you can't make that loan. You can't pay back that loan. Your company will not thrive. On the other hand, you can go into one of these things and look at it, and these companies are so small that you can buy one and lose, in some cases, you can lose one customer, and your debt service coverage ratio is just blown right out of the water. And that is, it's a function of concentration and all that sort of thing. But as companies get larger, swinging that debt service coverage ratio by losing one or more customers becomes more and more difficult. Conversely, the smaller the company is, it's important to be able to cover your debt. Dick's calculation is, in my view, a perfect one to be thinking about, but always realize that your clients, your customers, if you start losing them for whatever reason, and the more commercial your company is, if there's concentration, that coverage ratio could go out losing one customer. So don't fool yourself into thinking that, gee, we've got a 1.4 coverage, I'm good. You may be for that month, but you may not be 3 months from now. And so the real, I guess the point is, you're going to go into that, the SBA is going to make sure you go into that with a positive, you meet the threshold or above it. But sales is your friend to keep that number up, because you will always have turnover in your customers. especially if you're dealing with commercial clients. And that's why I think it was Ben, or it might have been Brian, I don't remember who it was, made the comment about the difference between commercial and residential. Residential clients can be a lot stickier because they're smaller, and you may lose one or two, but it's not going to throw you completely, out of the loop with your bank. I don't know if that's helpful, but I find it, the smaller the businesses are, the greater the risk profile, the higher the beta.
Hey, Dick, I got a follow on kind of to what Dana just said on the problem, to solve the problem you said at the beginning of this, reducing your cost of goods by 50%. How realistic would that actually be?
Well, and that's why the back of the calculations are so, and understanding the numbers that the seller's got. Maybe he's got something hidden there in the cost of goods sold, like he's got a relative out in the field that's doing the work and he doesn't really do the work, you know what I mean? He's on the payroll and he's paying him $150,000 a year, but he's not generating any revenue. So you really got to look into those numbers. Or he may not be putting out for bid the material that he is buying to turn into the cost of goods sold. And so you may be able to put something out for bid and save a few dollars that way. But the reason I went through that calculation is because it does take an awful lot to turn that ship around. I mean, if a company's only making 100,000, you've got to come up with 400,000 in debt service. You got to start looking at those things and saying, okay, where can I pick up? And if the answer is I can't reduce that cost of goods by that much, then walk away, because it's probably not going to get any better. And keep in mind that debt is paid off by profits. You can sell assets and pay your debt off. You can do some other things to pay that debt off, take out another loan and pay it off. But your principal payments are paid by profits, and that's something sometimes hard to realize. But profits at the end of the day is what pays the money back. Okay, Andy, next slide. Okay, now that we've calculated that size of the deal, let's look at the feasibility. So what are some of the things that, and Doug, you made an excellent point. You got to reduce your cost of goods sold by 15% to come up with to pay that. So is that feasible? Probably not. So what are some other ideas that or thoughts that you can have on, once you've got this calculation, then you have to ask yourself, is it feasible? So what would be some of those questions you would ask yourself?
Can you change the business model somehow?
Add another product or service or something like that?
Yeah, or thinking of an HVAC company, can you do like a monthly checkup type service or something like that?
Yep. Okay. Good one.
Will the seller accept the price that you can offer? I'm seeing a lot of overpriced stuff recently.
Yeah, I always tell my clients, this is what the seller wants up here. Here's what you want to pay. Trying to come in the middle is where the rubber meets the road. Okay. Well, I know we want to get into module 3 here, so I'm going to skip that over to the next slide, Andy, or do the next one. So some of the things we wrote down as feasible, and we kind of talked about this. Do the revenues have to increase substantially to make the deal work? What has the revenue trend been like? If you've got to increase revenue to make the deal work and revenue has been dropping or staying flat, then you have to ask yourself, are you going to add an additional product or service to get that revenue up to make this thing work? One of the things I think that's overlooked, and we had an Acquira client recently that went through this, and that is, what are fixed assets that need to be replaced? You know, if you've got a HVAC company and you've got 10 trucks out in the field, and they all got 300,000 miles on them, you're probably going to need a new fleet. And I don't know if you've priced trucks out lately, but you can't get much in the way of new trucks anyway for much under 40 or 50,000 bucks. So you can get used ones for less than that, but you better count on having ability to finance those fixed assets that need to be replaced. Is the business located in a growth area? There's a lot of sections, and I live in Houston. There's a lot of sections that, you know, they're going to come back, but they're not coming back in the short run. So if the area is not in a growth area, you may not be able to get those sales where you need to be to make the thing work. And then there's a lot of information that you can get on industry averages. So if you've got a HVAC company that you can look at, try to get the information on comparative margin ratios and comparative expense ratios to your industry average. So if a company's got a 65% gross profit margin and the industry is something different than that, well, why is it? Look into it and see if you can turn that around, or if there's some numbers in there that don't make sense. Or the example that I use as an individual out in the field that he's paying a big salary to that's not doing anything, but it's a relative. So, and then keep this in mind, don't drain your personal resources to make the deal work. And what I mean by that is, if you're coming from a corporate America right now and you get a paycheck every month, and you're the small business owner and you've got people to pay to keep your employees, you may not be able to draw out that same salary that you were drawing out when you were with corporate America, or you may not be able to draw a salary at all for the first few months. So make sure you don't tap all of your financial resources to make the thing work, because you've got to pay your mortgage, you got to pay your light bill, you got to pay your car payment. So make sure you keep a little money back to make all those things work. Okay, next slide. Any questions or comments on the back of the envelope calculation? Did you find it helpful, useful?
Mhm.
Okay. I'm going to give that calculation to Andy, and he can send it out to everybody that I went through, and because I did go through that relatively fast. And Dana, thanks for that comment. Module 3 is the one, now that you've found the company, you've narrowed your focus, you found it, you made an offer, you think you can get it financed. In module 3, next slide, do you have enough cash? And how much is enough cash? Next slide. And you've probably heard the phrase that cash is king. And it's never more important as when you first start out. And whether it's a existing company you're buying or a startup company that you're buying, and I know none of you are doing that through this process, but a lot of the same elements are in place, whether it's an existing company or a brand new startup. So next slide, Andy. So what are some of those expenses that you have written down or that you thought about that you need to put in your calculation, either operating expenses or that, closing cost that you're going to have to come up with as you start this process? So anybody got any comments there?
Yeah, I mean, if you need to make any capital investments in year one, you're gonna have to account for that. If you're gonna plan on adding any SG&A staff in year one, you have to account for that. Similarly, I mean, the typical example Acquira gives is if you're going to do any year one, like digital upgrades, new website, if you're going to hire an agency for that. So those sorts of upfront investments in year one are important.
Okay. Anybody else got any? Okay, next slide. Let's go over some of these that we came up with. Next slide. Okay, some of the uses of cash in that year one. Let's say that the former owner owned the building. And so all the information that he gave you in the way of financial statements doesn't show any rent or lease payment. So he's going to keep the building and you're going to rent it from him. So now you've got to add that lease payment or that rent payment in there. It depends upon what kind of lease it is. If it's a triple net, you got to pay for all the repairs, you got to pay the taxes, you got to pay everything. And so again, if that hasn't been calculated, well, the expenses would probably be showing up in his financial statements anyway, but certainly the loan payment wouldn't be. And then any loan payments. Obviously, we talked about the loan payment to the SBA. That's going to be in your calculations. But the example that I gave of trading out that fleet of older vehicles, factor that payment in too. Utility deposits. A lot of these utility providers, water and phone and that type of thing, if you're a new company, a new owner of the company, you're now a new person. You're not the same person on the other company. So they may ask you to put up that first month, last month's utility deposits. If you've got a heavy water in Houston, they have a water tax, and it's based upon not only the water you use, they calculate how much water runs down the drain, and they charge you for that as well. So it's usually a pretty big payment. Equipment upgrades. Brian, you mentioned that. And then system upgrades. If you've got an online QuickBooks system and that's the way to do it, and you've got a system that's just the in-house version of QuickBooks, you may have to upgrade the new QuickBooks system. Payroll. There might have been some relative that's in the back office that does the payroll. She leaves or he leaves with the company, so now you got to get a payroll service involved in setting the thing up, and usually they'll do it, but there's a fee associated based upon the size of the payroll that may not have been factored into the financial statements you got. Insurance premiums. There may be a down payment because you're a new startup company. Somebody may not finance on a monthly basis your insurance payments. They may want to have you pay the first payment, last payment, or even pay the premium up front in full. Marketing expenses, building that website, maybe hiring a marketing firm to look at all your collateral material, social media, all that stuff costs money. The inventory that's in the back shop may need to be replaced, or you may need to build up the inventory because you're going to change your model and you need more widgets than you thought you did. And then another area that a lot of times goes unnoticed is that, again, if you're a new company, a new owner of the company, your supplier doesn't necessarily have experience with you. They got it with the old owner. So they may want to put you on a cash account, not give you an open account, or maybe not give you as much open credit until you get established with them. So all these things you can see, if you didn't factor that into that operating expense or in the closing cost, not a lot of this is, well, it could be, some of this could be closing cost, but you're going to wind up at the end of the day with not enough money to fund all the things that you need in that first year of operation. And Dana, I know you probably got some comments on this one too, right?
Only a few. Yeah, these mount up and they can be relentless. They can seem relentless if you haven't focused on them and haven't thought these through. They can really be. Let me give you an example. We had a client came in, thought, well, we'll spruce up the marketing expenses and expand the residential side, and got tied into a marketing group that was charging him $8,000 a month, minimum commitment of 3 months. And there was basically very little, if any, return on that at all. So he was out $25,000 just in the first 3 months of the business, which he did not need to be out. There are multiple others going in and finding, all the employees are using their own laptops. So all your data, everything you know about your company is on somebody else's laptop, their personal laptop. So you need to make sure you understand that, what that looks like. And bringing in a new system for the company can be a pretty rigorous experience and a somewhat expensive one as well. It just so happened in one case that Dick was very close to somebody that could help out very, very well. But it still was quite the hurdle for the company to go through. And as it turned out, a couple of those folks left and took their laptops with them, and they were not particularly gracious about giving them data, the company's data. I would tell you, we'll get into an inventory discussion in a minute, and Dick hit the suppliers and system upgrades and that sort of thing. So I think that's probably makes the only points I need to make.
Okay.
I got a quick question on this one.
Yeah.
Would an asset buy versus a stock buy mitigate some of these things?
Yes. Yes. Yeah. If you buy the stock, the name of the company is probably going to be the same. So a lot of these vendors may not want, they don't look at you as a brand new company. Some of the other utility companies, equipment providers would look at the company and say, yeah, you've been in business 20 years, same name, just got a different person in the chair. If you change the legal structure of it, now it's Fred Jones operating as the same name of the company. They're going to look at that as a brand new business and say, okay, utility deposits, open accounts, go to cash. And so, yeah, it does make a difference, Doug. Great point.
And before you do that, you need to make sure that there aren't any liabilities hanging out there.
Yeah. Yeah.
Oh, believe me, Dana, I know that. My wife's a lawyer, so I know that one.
Okay. Okay. Not everybody here might know that, but hopefully they do. I don't want you to find out the hard way. That's for sure.
Yeah. Yeah. And a lot of that stuff can come back and bite you, and, you don't even know that it's out there. When you sign the paperwork to buy this business, somebody could be at their attorneys ready to sue your company. You find out the next day. Okay, so next slide, Andy. So now let's go through quickly because we've got about 5 minutes left, and we may go over if any of you've got to leave to attend another meeting, that's fine. But if you want to stay on here, it looks like we are going to go over a little bit. But what are some ideas on some of the reasons you can identify that you might not have enough cash? This would be in the negotiation point. And I'll throw an easy one out there to get the conversation started. You don't have a line of credit as part of your financing. Bank's just going to provide you enough money to buy the company without a line of credit.
Well, we said earlier about the timing, if you're especially in your commercial business, the timing of customer payments could disrupt your cash flow.
Okay. Anybody else got any thoughts?
Well, I was just mentioning in the comments, just no cash coming in with the business as part of the sale. Ultimately, they're taking it all out and running, or rather, you didn't negotiate for it to stay in.
Yep, that's
There you go.
That's a great one, Michael. Okay, and let's go to that next slide and show you the list we came up with. Again, what you just said, Michael, the owner's taking out all the cash at the time of sale and leaves your checking account with 1 cent in it. the seller makes claims to all accounts receivable. That may not have been what you purchased. And if you can negotiate that as part of your purchase price, that's great. But make sure you're negotiating for the right receivables. We've seen some of these deals where the seller is more than happy to leave receivables in the business, but they're the ones that are 90 days or more past due. So then you got to pay in a collection agency or somebody to collect those, and that's not immediate cash, and you're probably going to come up with some lesser amount than the actual amount that's on the books. This is an extremely one, the one I first mentioned, and that's to make sure that you negotiate a working capital line of credit as part of your loan package. So you don't need just the equity loan to buy the business. You need a loan that's a line of credit that you can call on with some relatively ease. I know some of these SBA loans, you've got to then, before you draw it, you've got to provide current financial statements, current receivables, current this, current that, then somebody's got to look at it. So you may need the money yesterday. And by the time you get all that information and somebody looks at it, maybe 3 weeks before they can advance against that line. So make sure your line of credit is easily accessible when you need it, not when the bank, decides you need it.
And just to be clear on that one, is it the line of credit in addition to whatever working capital you also get built into your loan?
Yes.
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 I have a question about the line of credit.
Uh-huh.
How do they go about qualifying you for that line of credit? Like, because I know the amount of loan that they give you to purchase the business is based on the cash flows of the business.
Mhm.
Is that line of credit considered additional to that, or is that kind of a side pot?
Yeah. Usually what the line of credits do, Ben, is they have a reporting requirement. Like they say, we'll loan you, you can draw up to X number of dollars, $100,000. You have to give us an aging schedule of your accounts receivable. And that aging schedule, they'll discount everything. Well, they won't even discount. They won't allow anything over 90 days. They'll discount maybe anything over 60 days by 75% or 50%. And they'll advance you 80% of everything that's current, or 30 days. And they may have a factor in there too for inventory. Like they'll say, I'll also loan you 50% of your inventory value. So when you draw that, and you have to report the aging schedule and the inventory schedule monthly. So they'll have that on file. So now when you call and say, okay, I need 30,000, they'll look and make sure that the receivable information that they have is current, within the last 30 or 45 days. And if it's you had availability to draw under that line with those calculations, they'll just advance it to you. So make sure that it's truly a working capital line and not we got to have all this and all that before you get advanced.
Okay, so it's based on your receivables
And inventory.
and inventory.
Yep.
Okay.
And it's on a formula basis.
Yep.
Got it.
And those formulas, different banks can approach them differently. And sometimes you can negotiate a 55% advance rate versus a 40% advance rate or something like that. But most of the time, the bank will have if it's a true bank, it will have a formula that they use all the time or very frequently. There are other kinds of lenders that can go in greater advance rates, but they also have greater controls over your cash.
Yep.
So, and they're not going to want to get involved, or your SBA lender won't want them involved when you've got an SBA loan. They're not going to want you to have another one. So you want to try and negotiate that with the SBA lender.
Yeah, that's a good point, Dana, because if you don't negotiate that, and then when you do need the money, you go back to that SBA lender and they say, well, we can't loan you any more money. They have a first lien on all that stuff. So you're not going to be able to find another lender that's going to loan you the money when they've got a first lien. So they're in control. And if you don't negotiate that up front, you're going to be very difficult to try to find a new lender to come in.
Another point on that, Ben, is some lenders will do that in due course. They will make you the loan to buy the company and provide you a working capital line. It will help your understanding of how working capital works to negotiate that with them. And it is in their best interest to do that for you, even though they are loaning you more money. It's in their best interest because the last thing they want is for you to run out of cash.
Yep.
And so that's the argument. If I were in one of your seats talking to a banker and they say, well, we just don't want to do that, make the point to them, hey, it's in your best interest. I'm setting this up. I'm hoping never to borrow it, but I'm setting this up to make sure that this company is viable. I don't intend to have it forever, but I want it during the period where I have the greatest risk. And frankly, you, Mr. Banker or Mrs. Banker, you have the greatest risk as well.
Yep.
We want to structure this properly.
I might have missed it, but is there a monthly rule of thumb for, like, I don't know, 3 months of working capital, get that as a line of credit, or is there something like that?
Yeah, I would look at trying to get at least 6 months worth of operating expenses or 3 months, because if you do run into a situation, I'll give you a prime example. I'm a big proponent of people doing business plans. And I can guarantee you when everybody was doing their business plan in December of 2019, nobody put in there in April of 2020, the whole world was going to shut down because of COVID. And I can tell you that a lot of cash registers were not ringing for about 90 days after April 1st. And if you didn't have a line of credit or have some availability to cover that before they came out with a PPP loan process, you were just, closing the doors. So, if you can get 6 months, that'd be fine, but I wouldn't do anything less than 3.
Yeah, I know Alan from First Internet has told me for their working capital lines of credit, they recommend last year's COGS plus expenses over 4.
Yeah.
That's the formula he recommends, just to be safe.
That's good.
It's a lot.
It's not bad.
And then again, I reiterated here, don't use all your personal cash to buy the business. Sales may dip after your ownership change. I was in banking for 40 years and I never saw a set of projections that didn't work. Up front anyway, they didn't work afterwards, but in some cases, but you can kind of guarantee if the owner's been well-known in the industry, well-known in the community, and he leaves, your sales are probably going to take a little bit of a dip. So don't plan on a hockey stick when you take over. And if you plan on a little dip of sales and you can't meet those repayment hurdles, and got to figure out where it's coming from. We talked about the startup expenses not factored in. And so, make sure you make a list of all those. If you're buying a restaurant, you need a liquor license in your name, for example. That's not cheap. You need so much inventory. So those things are not cheap either. So make sure you get all those expenses factored in there. And a lot of them you can pick up and I think we had a conversation on one of these calls from the woman that was talking about the ad backs. And the owner's going to provide you a lot of ad backs, and you want to look at those ad backs and make sure you've got whatever those ad back costs are factored into your expenses to make sure that you've got enough money to cover those. Okay.
Hey, Dick, let me make a comment on that.
Yep.
I'm looking at all of these deals that we're sending out to the group here, and I see companies all the time showing an SDE of X, whatever it is. And then when you talk to them, you find that the owner the seller is the chief cook and bottle washer doing everything. So that SDE is vastly overstated for a new person coming in, because you've got to replace, unless you want to be the chief cook and bottle washer, which I don't think you want to be, you're going to have to replace a lot. So the SDE is overstated, and you need to factor that into how you approach the valuation of the company that you're willing to pay. Does that make sense to everybody?
Yeah, I recently asked, and Hayden answered it. So the SDE multiples that you use in the intrinsic value, it is the chief bottle washer. It's like it's all in 100% owner's comp back into the SDE for the smaller companies in terms of just gauging the valuation. But then when you go do the modeling for the pro forma, you need to back out a GM or some sort of salary that you're from the adjusted EBITDA. So I think it's you use the full SDE to get a sense of valuation, but then you back it out when you do your pro forma.
Yeah, I would agree with that, but I also, what I'm saying is that that person may be doing other jobs as well.
Yeah.
Not he's paying himself that, but he's doing the job of an HR person. He's doing the job of a general manager. He's doing, two other jobs at the same time.
To figure out how many
Sales,
how many people you need to hire and what their expense would be. Okay.
If somebody is doing that, and a lot of them you'll see in the last year, they have just jacked up the SDE on declined sales. And I don't know if they're firing a bunch of people for the last year or what. It may not be that, but I just want you to realize, or to ask the questions is really the point. Yeah. What exactly are you doing? And, who's your GM or who's your head of sales? And if they say, well, that's me, that's me, you need to kind of factor in they're inflating their SDE. Is what they're doing. That's kind of the point.
Yeah, I always ask for an org chart, and then I say, well, what's that person do? And if again, to go back to Dana's point, if the owner is doing sales, negotiating contracts, negotiating with vendors, doing the HR, doing the bank financing, wait a minute, I'm not going to do all that stuff. You might want to factor in at least two other people.
Feel like a hamster on the wheel.
Yeah. And then your first point, the seller may have taken all the cash on hand. Isn't that typical? Isn't that almost always the case, especially if you're doing the asset sale?
It needs to be clarified right up front. We're going to need this amount of working capital. You're buying a company that, at least theoretically and for your benefit, is a going concern. If you take all the cash out of it, it's not a going concern, it's a bunch of assets. So you're going to have to fund that, and it's okay to negotiate that. It may be even cleaner, but you have to have that planned in, and not assume that the company is going to have true cash and working capital that converts to cash. Don't assume that will be there if you haven't addressed it in your purchase agreement.
Okay. Because in the LOI template that Acquira has, they pretty much, the way I was reading it is, the seller's taking all the cash. Do you typically then you really don't address that in the LOI portion? You address it as part of the final purchase agreement?
I've seen it both ways. I like it addressed sort of generically in the LOI. We will come to an agreement on, and then it becomes a negotiating factor in the purchase agreement. That's the way I like to see it.
Right. Because I would imagine most sellers are going to say, okay, well, if you want me to leave this much working capital, then the price has to, they're going to try to directly offset the price, and then you're going to have to go back.
Maybe not. I mean, that may they may try to do that.
Yeah.
The question for you is, how much are you willing to pay for the company? And if you have valued the company, that company may be worth a lot more to them than it is to you.
Sure.
And I mean, there are just countless examples of an asset, a cash producing asset being worth more to company A than it is to company B. And it's the same with individual buyers. But if that's the way they want to approach it, then I would pay less for the company, because part of the purchase price is to make sure you're buying a going concern. That is a concept that is really important, that it needs to be able to run on day two. And if you can't pay your payroll, it's not a going concern.
Yep. And what a lot of lenders in Houston do, SBA lenders, is on an asset purchase, they want to see the list of all the assets that you're going to buy. And if cash isn't on there, then you're going to assume the owner's going to take it out. And my argument has always been to those guys that want to take the cash out is, well, you want $2 million for this thing and you got $400,000 in your checking account. So you really want $2.4 million for this thing. You don't want $2 million for it.
Right.
And so, get that list of assets that you're going to buy, cash, receivables, inventory. And so then when they come back and they try to renegotiate the deal after you've closed, you can say, well, that wasn't on the list, or that was on the list. I get it. So really important to get that list of assets.
Okay.
Okay.
I have a follow-up on that. And this is something I've been running into recently as well, is like, when and how is working capital typically negotiated during the offer process? Like, I know it happens later on, but I think one of the things I've been facing is just what you guys said, is that up front, there's not normally a mention of working capital. And in all of the LOI templates I've seen, I haven't seen working capital explicitly called out. I did put an offer in on an HVAC company a couple weeks ago, and the broker called me and said, hey, what do you want to do about working capital? Because he's concerned about net cash to owner, right? Like, he's a good broker. He's thinking about that up front. But I think a lot of these brokers aren't thinking about that up front. And if you put it in the LOI, then you're kind of at a disadvantage, because exactly what you said, the seller's discounting the purchase price by however much working capital is. But then if you don't put it in up front and agree to it, then they may negotiate you out of it later. So it's it's like, how do you even get past the LOI stage to get into the offer? But then how do you protect yourself on the back end? I don't know. What do you guys see? What's typical, and how do we position ourselves best in both getting our offer accepted and at the back end and having it included?
Well, your LOI, and I'll let Dana chime in too here. Your LOI is just a basic, you're interested in the deal. You haven't seen any numbers yet for most cases. So once you get all those numbers back, then you can start negotiating the contract. So, and it's never going to get any better than that first one that you give him. It'll get continually worse for you and better for him. And that's why an attorney needs to be involved, I think, on the front end of your deals too. Dana, you have anything else you want to add to that?
Yeah, I'm trying to think. I think I know. There were a couple of deals that I thought were handled really, really well. And I may be able to snatch a little bit of the language that addresses that working capital need. Both of them were I think both of them were in the LOI. And it basically, it's a framework. It basically says, we will in good faith negotiate, and I'm paraphrasing from 4 months ago memory, basically, we will negotiate the working capital arrangement, or I can't remember the language. Let me see if I can find that. If I can, I will cut and paste that into an email and send it to Dick. I'll send it to you. Make sure you're okay with it, and Andy, so Andy can send it out to the group. And basically it just sets it up. It's, this is here. The LOI is the framework of what I intend to do, assuming things check out. I am interested at this level. And then you go into a QOE, you start negotiating a purchase agreement, you list out the assets, and that is one of the negotiating points that is key in negotiating the purchase agreement. So I'm absolutely where Dick is. You want that addressed. I didn't know people were sending out LOIs without some reference to it. I hadn't seen that.
Yeah, I think I've seen a lot without it, but
Okay.
The simple version that I saw in another online was they would just talk about 3 months of working capital. Just keep it in word rather than coming up with a number. Come up with the concept. Hey,
Correct.
this includes 3 months of working capital, and then you figure out what that exactly calculates out to later on. Was a simple one I saw.
Yeah, I've heard that discussed like that. I haven't seen that in writing.
Okay.
But again, it's kind of an agreement to set that aside. We know we're going to deal with that in the way it was addressed really well. We need to make when we buy your company, we need to make sure that we have enough, working capital and cash in the company to make sure that the company continues.
Right.
It's on the seller. It's in the seller's best interest. It's in everybody's best interest. But sometimes the sellers don't really see that.
Yeah.
Because what they see is green.
Yeah.
And they want more green. So you kind of sometimes you have to do their thinking for them and educate them about it.
So I guess what I'm hearing to summarize is that the best approach to this is to say we'll negotiate working capital, but bury it in a line item somewhere in the LOI, so that way your total purchase price shows up as big green to the seller, and so it gives you the best chance of getting your offer signed. But you agree within the LOI to discuss it at a later date, and that it will be included.
Yeah, then you define it in the contract.
Okay.
Somebody can have a different meaning than you do of working capital.
You're buying the company, and working capital is part of that company. That's what you're buying. In addition to the 4 forklifts and the 18 trucks and the whatever else is there, you're buying working capital. That company has to have. It's like having the gasoline that makes the motor run.
Right.
It's got to be. It is part of the purchase price, and without that, there's no deal possible unless you want to pay more for the company, or I suppose you could approach it and say, well, then I'm not willing to give you the price that we talked about. Right. So that there's, it's better to address it up front, make sure that everybody kind of understands where you're coming from. But working capital is part of what you're buying. It's not in addition to, and you're not going to double pay for it. You don't want to. So
I agree with all that. It's just like, where do I put it in the LOI so that way it's accounted for, but it doesn't hurt my chance of having an offer accepted? Because I talked to
I understand.
Today, she said, like, I haven't seen that highlighted, and maybe that's why you're not getting your offers accepted. And it's like, okay, so I'll figure it out on that one.
Sure.
Okay.
Okay. Let me. I will make it a point, Ben, to see if I'm thinking of 2 companies right now, and I will make it a point. If not this afternoon or tonight, I'll try tomorrow to get at least one sample of language to you, so that I would include it in the LOI, because I'm aware that people can try and turn that on you in a negotiation. So
would love to see that language, because, and like Brian said, I haven't, a lot of the LOI templates I've seen don't talk about it.
Yeah. Okay. And on another point, on that very point, I've heard that there are multiple LOI examples floating around. I just haven't seen them all. So maybe I just haven't been exposed to that one or two or whatever they are.
Yeah, there's one on the Thinkific resources. That's the one I was looking at.
Okay. Okay. And I don't recall that one, but okay.
Cool.
Okay.
Thank you.
Thank you,
So
Dana.
we're at 422. I've got about 2 more examples here we want to run through. We still have 22 people on the line. We had 23 when we began. So I guess we're holding your interest, or there were more people that have dropped off. So
That's less than a 5% loss factor, Dick.
that's right. So let's try to run through these last important slides here. Yeah, go back to that one you just had up there, Andy. So what are some of the things that we can do to avoid some of these things we've been talking about? One of the things that we would not want to do is, whoops, wait a minute. Can you go back a couple more slides, Andy? Yeah, that one. Okay. What are some of the things we can do to prevent from this happening? Focus on those uses and of funds that we talked about up front, and make sure you include all of those items. Make a working capital line of credit part of your loan request. We talked about that, making sure it's enough to cover 3 months worth of operating expenses. One of the things the SBA does not like to do, but they have the ability to do it, and that's to request an interest-only period on the front end of the loan for the first 3 months. And when you look at a repayment schedule for your SBA loan, I can tell you you're probably paying a nickel the first month on the principal, and you're paying $20,000 on the interest. So if you can get an interest-only period and on that loan, it can save you some money. And if you can get it waived and not pay any interest on that first 3 months, that's built in on the back of the loan. That would be an ideal situation. A lot of lenders don't like that to happen, but if I would negotiate it, if you don't ask, you're not going to get it. Purchase some amount, or put some amount of cash that's left in the business in the purchase. Just went through all that. Negotiate receivables if they're left in the business. You only want the ones that are 30 days or less. You don't want the 90-day receivables. If he does want to leave them in, or she wants to leave them in, they should compensate you for collecting those. So make that arrangement to be their collector for it, and you get some money for making the phone calls. And then I alluded to this, hold back as much of your own personal cash as you can to cover 6 months worth of your personal expenses, because you may not be able to draw as much of a salary as you were when you were employed by Exxon or Shell or whoever. Okay, Andy, flip over to the 2 more slides. Okay. Yep, the next one. What are some of the things you can avoid in cash from putting in cash into your company? Next slide, Andy. Yep. Don't, I know it's kind of a last resort for some people, but to take out a home equity line on your personal residence. A lot of banks make those easily available. They're usually attractive because you can deduct the interest on your personal tax return and all that good stuff. But 9 times out of 10, I've seen a lot of those home equity loans that just never get paid back. So use that as a last resort to cover any of these shortfalls.
Isn't that often, can you even do that if your home has to be collateral as part of a deal?
Yeah, in some states like Texas, you can't pledge your house for collateral on a business loan. So I guess some states you can, but again, if it's pledged for collateral on the loan, you're not going to be able to get home equity anyway, because I know in Texas you can't borrow more than 80% of your home value in total. So
got it.
Running up outstanding balances on your personal credit cards. if you look at the interest rates you're paying on those credit cards, it's 22% or higher. And if you're looking at the minimum payment that you can make on a credit card, you might be paying that thing back for 35 years. Not following your business plan and chasing the shiny object, that can get you in trouble. You write a business plan for a reason. This is what I'm going to do and how I'm going to do it. And so often when you're in business, that shiny object comes in front of you and you want to drop everything you're doing and go chase it because it's going to make you a ton of money. And you wind up spending a lot of money on it, and you probably aren't going to do it anyway. Letting the seller come back and try to retrade the purchase. We saw one deal where the seller didn't include inventory. And then after the purchase said, oh yeah, there's $200,000 worth of inventory in the back garage and you didn't pay me for that. So don't let the seller come back and try to retrade the deal after closing. Take your foot in your paperwork and say, hey, this is the deal. Too bad. Not rolling a cash flow statement and updating it every week, not doing a rolling cash flow statement, not updating it every week. Why that's so important is you will pick up long before a negative cash position happens. And we did a presentation on that rolling cash flow, and be more than happy to do it again at some point if you get to the point where you need that. Not only using your personal cash flow to buy the business. Ideally, you need enough to cover 6 months expenses. That's an idea that was back in a couple of them. And if that's not important, I wouldn't have put it in 2 slides. So trying to obtain a loan on a non-conventional lender. We talked a little bit about that. The SBA's got a first lien on everything, and they're not going to give you, they're not going to let a second, well, a lender may take a second lien on it, but they're not going to give up their first lien position. And so if you've got a lender that's willing to loan you money without a lien on it, there's usually going to be a higher interest rate and large fees associated with that. So Dana, I covered that pretty quick. You got any additional points to add in there?
Yeah, the only additional point, we're way over, but the additional point I would say is don't discount Dick's rolling cash flow. He's got a great approach to a 13-week cash flow. It's used by companies everywhere. May not be something you're used to. You may think like it's a big pain in the rear end, but I am telling you from experience, it is incredibly valuable. Incredibly valuable. You will not only learn about your company, not only predict, what's going to happen, but it enforces a discipline that keeps you looking at what counts. So I think I couldn't endorse that more strongly.
And just a quick question on that one. You mentioned is 13, but this one here also mentions the 1 week. Where do I find out more about the 13?
Where's a 1 week?
Well, it's updated every week. So
yeah.
Oh, okay.
Yeah.
Yeah, it's a rolling cash flow. So every week you're updating it for the next 13 weeks.
Okay, I get it.
And on a spreadsheet, you can do that basically forever. And it will help you stay focused on everything that's happening in your company.
Yeah, and one of our clients we did that with, they played with it and ran it out, and they says, boy, I didn't realize this, and in week 12 I ran out of money. And that's better to know in week 8 or 9 or 10. Then you can maybe not pay some of your payables that are due out there and hold them off a little bit, but at least you knew it was going to happen. And if you go to your bank and say, I got some payroll checks coming in, I know I don't have enough money to cover it, I can tell you that won't be well received.
On that point, though, it also gives you the ability to approach the bank with sufficient lead time to ask for some additional funding if you need it. And there are most of the banks that are doing SBA loans want to protect that loan. And if you can sell them, which it can be done, we've seen it done many times, you can essentially get the kind of working capital support you need. What you don't want to do, if you can avoid it, is to ask them to fund losses and not be able to show them that how you're going to get out of it, how you're going to pay it back.
Quinn, you asked for that, and did you want a copy of that too, Michael?
That would be awesome. I love the concept, and it actually just put me at ease hearing about it, especially with the business I'm looking at right now, because they haven't been so good at that. So yeah, that'd be great.
I'll send you those templates directly, and if you have any questions, just shoot me an email back.
Thank you.
Could you also send me a template as well for the cash flow? Roland?
Okay.
Yeah, maybe you can just share it on the Acquira.
Okay.
That'd be wonderful. Thank you.
Thank you.
Yeah, I'll send a copy to Andy, and he can put it out there too. Okay, well, thank you guys for your time. Sorry we ran over, but obviously you all stayed here, so it must have been some valuable information to you.
This was great. I really like the style. Thank you so much.
Yeah, thank you so much.
Thank you
Okay.
guys for participating so well.
Have a good one.
Bye-bye.
Bye-bye.